Hello guys, welcome back. So today we're going to talk about how you can determine bias. When I mean bias, it could be daily bias, it could be weekly bias, uh, could be your 1 hour bias, your intraday bias. But predominantly in this video, we're going to talk in-depthly about weekly bias and daily bias. So before we go right into this, I want to quickly mention, because this is very important as well. When you want to do your bias, for example weekly bias, you do not do the bias when the week is running already or when you started the week already. You want to do your bias on a Saturday when the market is closed, or on a Sunday before the market opens. In other words, you do your bias before the new week's candle opens. This way it gives you clarity, a clear mind to know exactly how to navigate and make decisions clearly. On the other hand, when you're doing your daily bias, you make sure you do your bias on the previous day before market opens. For example, if the market opens by let's say 10 p.m. your local time, or 11 p.m. your local time, or 2 a.m. your local time, whatever the case may be, make sure you do your bias for the next day. For example, if I have plans of trading tomorrow, let's assume tomorrow is the Wednesday, I will do my daily bias today, Tuesday, before today's market closes. That way I will have enough data to know how to do my bias for the next day. So you do not do your daily bias when price has opened already for the next day. You might be unfortunate, maybe candles are already flying around, you've seen big moves, and it might somehow make you think a market is going to a particular direction when it might later reverse. So do your bias analysis before the candle you're expecting opens. Now let's dive right into it. When talking about bias, there are 5 major things we need to consider. The first thing we're going to consider is internal liquidity. When I mean internal liquidity, we mean fair value gaps. You need to know what fair value gaps are. You need to know what volume imbalances are. If you do not have an idea about what these are, you might go to my YouTube channel and watch what is a fair value gap, what are volume imbalances. These are types of internal range liquidity. We call them internal range liquidity because they stay inside. They are liquidity that you find inside a range. For example, this is a fair value gap. This fair value gap is inside the range between this low and this high. So inside this very range, internal, that's why we call this internal range liquidity. Then we have external range liquidity. External range liquidity, we have examples like buy side liquidity, sell side liquidity. They are liquidity that you find outside of a range. For example, we have a range between here and here. Under this range, the down part here, anything below here is sell side liquidity. On top, anything above here, we call it buy side liquidity. So it is external, outside the range. So liquidity that is outside this range is called external range liquidity, but the ones we find inside the range, for example this fair value gap, we call it internal range liquidity. Now, if you've been following me for a while, you will see that I always say this: price will always do one of two things. Price will either seek liquidity or it will seek inefficiency. When I mean liquidity, I mean buy side liquidity, like price trading above old highs or trading below old lows. Then when I mean inefficiency, I mean something like fair value gaps. I am saying the same thing here, maybe just in slightly different terms. So price will do one of two things. We either raid liquidity, like buy side. For example, we have this high, we're trading above it, this is buy side. We have this low here, price traded below it, this is sell side. Or it will trade into inefficiency, which is its fair value gaps. So for you to understand bias, you need to understand what liquidity and inefficiencies are, which is internal and external range liquidity. You need to understand dealing ranges rather. You need to understand where we are in price currently. Are we in premium or are we in discount? And then finally, you need to understand where is the next draw on liquidity. Where have we been? Where are we coming from? Where are we going? So let's, without wasting much time, let's dive into these light examples right here. If you've been following me for a while on my YouTube channel, you see that I've been doing some weekly analysis, and most times, a good percentage of the times, these analyses are correct. I am not using any form of talisman or any form of omen to do this. It's just simple market analysis, which I'm about showing you now. So first off, let's consider the first thing on this list when considering weekly or daily analysis. This is my weekly candle, so that's why I'm using this as a weekly analysis example. The chart you're looking at is DXY, the dollar index. I like using the dollar index for all my analysis because whatever you're trading, currencies, metals, Dows, CFDs, whatever, name it, E-mini S&P, Nasdaq, whatever, you are going to need the dollar index to know how price is doing in whatever commodity or currencies you're trading. Now, I will do two examples in this very video. I'm going to use the dollar index and then I'm going to use the euro dollar. You can do the same for whatever you're trading. Now, let's consider the first one, which is internal range liquidity. So I want to do a weekly analysis for this very dollar index. Now, the week I'm doing this, the day I'm doing this video is on the 10th of Saturday. Today is 10th Saturday, and this is August 10th, Saturday, August 10th, 2024. So I'm trying to do this analysis for the week starting Monday, August 12th through Friday, August 16th, 2024. So I want to know, what do we expect for this next week? Now, in as much as this is me trying to explain to you what I'm expecting for next week, I'm using this video as a medium to teach you how exactly I do this week in, week out. Now, I won't fail to mention as well that doing weekly analysis is just like taking trades. You can never be 100% correct. But the more you are correct, the more win rate, of course, you get. And sometimes you might be wrong with your weekly analysis and then you're right with your daily analysis and you still make profit at the end of the week. However, it's very, very important to know how to know your bias. So now, what are we expecting next week? And how do we know what we're expecting next week? First things we're considering is internal range liquidity. We have a fair value gap here. Yes, in fact, what has price done previously? We have price reading sell side, which is here, and then we can use this. Okay, this is the last low before sell side, so we can use this as our market structure shift on a weekly time frame. That's why I did this in bracket W. So we have this as our market structure shift. So price has come down to a fair value gap, which is this. And then if you are a position trader, you can have a trade here. You buy here. Your stop loss will be here. Now, can we say this fair value gap was respected? Yes. In as much as we have this week coming down, the bodies tell the story. The bodies respected the fair value gap perfectly. The wicks do the damage, but the bodies tell the story. So this fair value gap was respected, and then we're coming back up. We've respected internal range liquidity, which is first. And then talking about external range liquidity, where exactly, when we are trading from internal range liquidity, where do we expect price to go? That's correct, external range liquidity. This is buy side. So naturally expecting price to come here to the buy side, right? Which takes us to the second one, buy side liquidity. So the question is, where do we have internal range? We have internal range after this market structure shifts, price is coming down. Where do we have external range? Here, buy side. So we've traded to internal range. We're expecting to go back up for price to read this external range, just like you are taking trades in your 1 minute or 5 minute charts. You have sell side, you have market structure shift, price comes back to a fair value gap, and then you're expecting price to leave that direction. That is exactly how it turns out in weekly time frame as well. Now, a very important thing to consider, even if you're not using this very model for your analysis, sell side liquidity, market structure shift, fair value gap entry, even if you're not using this as a criteria, let's say you can't find anything like this on your chart, what then can you do? You consider dealing ranges. In fact, for me, the dealing range is the most important thing when talking about buyers, daily or weekly buyers. So what is a dealing range? A dealing range is when we have a range between a high and a low, and we are inside that range. Now, where exactly can we use as our dealing range right now? We have this as a high and we have this as a low. We are inside the range. We have not broken this low, we have not broken this high. Now, I know some of you might be thinking, why don't I use here as the high and here as the low for daily ranges? It's simple. This high is not really significant. Why? Because this high didn't trade into any fair value gap we can see on the weekly time frame, and this high did not read any buy side, as you can see. So this is just like a random high. If we look to your left, there is no internal range, which is fair value gap or volume imbalance, and there is no external range liquidity, which is a buy side. So this high is of no real importance. So unlike this high, we read a previous high, which is external range. So this high is very important. This very high is very important because it rated external range liquidity. And this low is important because we traded into a fair value gap. So this low traded into a fair value gap, this high rated external range, so this is a perfect dealing range to use. So now that we have identified our dealing range, the big question is, it takes us to number 4. Where are we in price currently? Are we in premium or we are in discount? So let's use this range to this range. For example, let's use this range to this range as an example, right? Just a moment. Sorry. When we talk about where we are in price, here is what we consider. What are we in premium? Are we in discount? So if, for example, I take my Fibonacci tool, yes, I take my Fibonacci tool, I measure from this dealing range, which is this high, to this low. When we're talking about where we are, we're talking about dealing range. Where are we within the dealing range? So from this high to this low, remember, we are looking at targeting this buy side. So where are we currently? We are below 50%, which means we are in discount. We are in discount. So this simply means that it's okay, it's safe for us to be looking for buying opportunities to target this buy side. But now one may argue, but price is coming down aggressively. Yes. Now this takes us to the next thing that we're going to consider, which is draw on liquidity. What is draw on liquidity? Like I said, price would respect one of two things. The first thing is liquidity or inefficiency. Liquidity, buy side or sell side, inefficiency, fair value gaps. So the next thing we're going to ask ourselves right now is that within this dealing range, yes, within this dealing range, where do we have inefficiencies from this high to this low? From this high to this low. Now, price going back up, where do we have inefficiencies? Well, we have an inefficiency here, a fair value gap. Look at this low and look at this high. Yeah, we saw price respecting that, coming back down, and they've been going back and violating that. But ultimately, that's not where we are targeting. We are targeting this, which is liquidity. So where are we in price? We are in discount. That's been answered. Let me remove this. We are in discount. The next question is, where are we going? We're coming to this buy side. Why do we say so? Because already we just left an inefficiency. We should be looking at taking out liquidity, external range liquidity on the upside. And we have not realized that. Instead, we saw price making a U-turn coming down. But what is price coming down here to do? A short-term low here. So let me extend this out to the right. There's a short-term low taking here, and this is what we call turtle soup. This is what we call turtle soup. A turtle soup is when we see price reading a low like this or a high. We see price reading a low like this, and then price running back up, closing above the low. Look at the close of this candle. Look at this close of this candle. The close of this candle. Price has gone up to close above the close of this candle. So when we have situations like this, it's a sign of reversal, and we call it turtle soup. In most cases, it comes in form of long candles like this, like long rejected candles, after reading a low. So we just readed a low, and then price is going back up, closing above the close of this down candle. We call it turtle soup. This gives us confluences to show that price is most likely going to reverse to the upside. Price is most likely to reverse to the upside to read this buy side. First, we're going to take this buy side and this and this, and ultimately this one. So what am I expecting next week? I'm expecting price to open, come down low, and then start trading back up. The first target will be this inefficiency here. This inefficiency, this high and this low. This will be the first target. But then, what then will be my invalidation point? Remember, we said our dealing range is this and this. This high and this low. This is our dealing range. So until we see price coming back down to trade below this low, that is when I will perish the idea of going long to this extent. For now, alternatively, I might see price open next week. Yes, I might see price open next week and trade. There is an inefficiency here as well. I might see price open next week and trade and come and fill in this inefficiency. That would still be very much valid. But the reason why I'm expecting higher prices right now is this turtle soup. It shows rejection to the upside, closing above this candle, above this candle's open and above this candle's close. This could call this turtle soup. But if price should come down and trade into this fair value gap, that's totally acceptable as well. But I would never want to see price come below this. Once that happens, my draw on liquidity changes. Currently, my draw on liquidity is here. Ultimately, this is the draw on liquidity. This is the immediate draw, which is a fair value gap, and then we trade back up to out this buy side, next draw, and ultimately this buy side. That is my bias. Now, alternatively, if we trade below this fair value gap and we trade below this low, then my bias will change to the downside. But for now, I'm still keeping my bias as bullish for the dollar index. So come next week, what I'm expecting is for price to open, trade down a little, and then bounce back up. Remember, there is an inverted fair value gap here on the weekly time frame. Look, fair value gap, a high and a low. If I should extend this to the right, I would expect price to react from this to the upside. This is a bit more complex for you. You might just ignore this. An inverted fair value gap is a fair value gap that was not respected and now serving as a support. For example, when price was coming down here and it's going back up now, we are expecting price to respect this fair value gap, but it didn't respect the fair value gap. Instead, we broke above and then we came back down and respected this fair value gap. We call that inverted fair value gap. So that is my bias on this very time frame, on this weekly time frame for next week on the dollar index. And for the euro dollar, I'm going to do that on another video since this one is taking a bit too long here. So to cap this whole thing, like I said, for you to determine bias, there are 5 things to consider. The first thing is internal range liquidity, which are fair value gaps, volume imbalance. External range liquidity, we can talk about buy side or sell side. Dealing ranges. Now, you can use dealing ranges alone to determine bias. By dealing range, we mean where do we have price currently? It's between which high and which low. Currently, we have price between this high and between this low, and I give you reasons why. And then ultimately, where are we currently in price? Are we in premium? If we are in premium, we should be looking at reasons to sell. If we are in discount, we should be looking for reasons to buy. And then ultimately, what is our draw on liquidity? Like, where do we expect price to go to next? Where are we coming from? In this case, we are coming from this internal range liquidity. Where are we going to? We are coming to this buy side liquidity. Where are we? We are in discount. So where are we expecting to go? We are expecting to come here. So if that's the case, depending on what the previous week's candle has done, we would want to think about what the next weekly candle will likely do. And I just told you with reasons that I'm expecting higher prices next week. I would favor a situation where price would open, trade down a little, and then start going up. So this is my weekly bias for the dollar index for next week. I'm going to see you in the next video where I talk about more on the euro dollar for determining bias for weekly and for daily.